Today, markets discombobulated by rate cuts and mixed rear-view mirror data, but still bets on AI growth. Hello again, it's Martin North from Digital Finance Analytics, with the latest posts covering finance and property news. Well, in this week's market review, as usual, we're going to start in the US, across to Europe, then Asia, and then Australia. And in passing, we'll cover commodities and crypto. I've been highlighting how the data-driven approach by central banks is a problem because as new data lands, markets try to respond, making swings in sentiment a core feature of every day. On Wednesday, we've got a rate cut from the Bank of Canada, who became the first major central bank among the group of 7 countries to cut interest rates by 1/4 of a percentage point to 4.75%, with Governor Tiff Macklem saying if inflation continues to ease and our confidence that inflation is headed sustainably to the 2% target continues to increase, it is reasonable to expect further cuts to our policy interest rate. Inflation in Canada has slowed this year to hit a 3-year low of 2.7% in April. While inflation has stayed below 3% for 4 straight months, it is still above the central bank's 2% target. The Bank of Canada joined Sweden's Riksbank and the Swiss National Bank in bringing down rates, and more central banks are weighing rate cuts. And on Thursday, indeed, the European Central Bank made a widely expected decision to cut its deposit rate from a record 4% to 3.75%, even though inflation remains above its 2% target, and it recently ticked up. So the ECB was prepared to cut despite inflation clearly remaining sticky, despite persistent wage pressure, and despite some signs the European economy might actually be improving. Not only is it one of the very few times that the ECB has made a turn on monetary policy before the Fed, it is also the first time the ECB cuts rates after a tightening cycle without facing a recession or crisis. But what's less clear is what Lagarde does next. Having delivered the historic first cut, she was very reluctant to give any clues on when the next one would be. Watch the data, she said. And in fact, global stocks pulled back from an all-time high on Friday after surprisingly strong US monthly jobs data dimmed hopes that the Federal Reserve would soon follow Eurozone and Canadian interest rate cuts, and that caused Treasury yields to shoot higher. The Federal Open Market Committee meets next week, but any rate cut at this meeting has been blown out of the water because the world's largest economy added 272,000 jobs last month, beating the 185,000 hires predicted by economists and derailing an investor consensus that the job market had slackened just enough to push consumer prices lower. The unemployment rate did inch up to 4% though. The diminished hopes for a near-term Fed move weighed on stocks, which closed lower after a choppy session. The MSCI's World Share Index dropped 0.3% after touching a record high. And Wall Street finished in the red. The S&P 500 fell 0.11% after hitting an all-time high of 5,375.08 points. The Dow Jones Industrial Average edged down 0.22%, and the Nasdaq Composite also lost 0.25% for the week. The S&P 500 gained 1.32%. The Nasdaq rose 2.38%, and the Dow added 0.29%. GameStop slumped 39% in volatile trading, just as stock influencer Roaring Kitty kicked off his first live stream in 3 years. The gaming retailer announced a potential stock offering and a drop in quarterly sales. Other so-called meme stocks followed, including AMC Entertainment and Costcorp. They fell 15.1% and 17.4% respectively. Nvidia's stock overtook Apple as the second most valuable company on Wall Street this week, but there has been a sharp rise in short positions as it extended previous session losses, with its valuation again dipping back below the $3 trillion mark. Data from S3 Partners showed that the notional value of short positions on Nvidia stock rose to $34.4 billion this week, representing about 1% of the firm's overall market capitalization. Lyft shares rose 0.6% following a forecast of 15% annual growth in its gross bookings through 2027 after markets closed on Thursday. Now, it's worth noting that US stock valuations remain well above historic norms, with the median price to earnings ratio of the S&P 500, well, that would need to fall 31% to hit its long-term median and 19% to reach its 20-year norms. The first quarter earnings did come in about 8.1% above analysts' expectations, but the growth was narrowly based, with the AI wave lifting the market higher. This is at best, well, toppy, I think, and the VIX, though, was at a low 12.22, reflecting, well, not much at all. The benchmark 10-year US Treasury yield, that's the benchmark for borrowing rates globally, leapt after the jobs report to 4.441%. That's the biggest one-day jump in about 2 months. The 2-year yield, which tracks interest rate expectations, climbed to 4.889% following 6 straight days of declines until Thursday. Of course, bond yields rise as prices fall. Money market pricing just after the payroll data implies traders saw the Fed only starting to cut rates from their 23-year high of 5.25 to 5.5% by November this year, and even that is far from certain. The US economy, it appears, is still strong, suggesting no room for rate cuts, and indeed, household wealth rose to a record of more than $160 trillion in the first 3 months of 2024, thanks to the stock market's record run and gains in real estate, according to Federal Reserve data that came out on Friday. Household net worth rose 3.2%, that's about $5.1 trillion, with the appreciation of equity holdings accounting for the lion's share of the gain at $3.8 trillion. And the Fed said in its quarterly snapshot of the nation's private and public sector finances, the benchmark S&P 500, of course, has gained 10.6% in the first quarter on a total returns basis. That's including reinvested dividends. The index hit another record high earlier in the week. And real estate valuations also added another $0.9 trillion, and upticks in other assets, including cash and money market funds, accounted for the rest of the increase. So household net worth has nearly doubled in the past decade. On the other hand, non-financial debt in total rose by 4.5%. That was led by a 6.2% increase in the federal government's obligations, although that snapped a run of 3 straight quarters of federal debt growth exceeding 10%. Household debt grew 2.9% and business non-financial debt climbed by 4%. Elsewhere, the dollar rose 0.8% against a basket of currencies, having been set for a weekly loss before the jobs data. The euro dropped 0.78% to 1.0803 a day after a slight gain. In oil, US crude futures traded down just a little to 75.41 a barrel on Friday, while the Brent contract dropped 0.54% to 79.53 per barrel, but continued lower for a third straight week on concerns over rising supply. In fact, the Saudi energy minister said that OPEC Plus could pause or reverse voluntary output increases if it decides the market is just not strong enough. The stronger US dollar weighed on gold futures, which dropped 3.33% to $2,311 an ounce. European shares had closed higher on Thursday, boosted by banking, technology and healthcare stocks, though they finished below session highs after the European Central Bank cut that lending rate. In new forecasts, the ECB said it expects inflation to average 2.2% in 2025, up from a previous estimate of 2%, and that means it was now seen holding above the central bank's 2% target well into next year. In fact, ECB President Christine Lagarde said that only one ECB Governing Council member had opposed the bank's decision to cut interest rates earlier in the day. But it does seem a bit weird that inflation is rising and they cut. But European shares fell on Friday, led by rate-sensitive sectors like real estate and utilities, after that stronger than anticipated US jobs report found worries that the Federal Reserve would not cut interest rates anytime soon. By Friday's close, the DAX was down 0.52%. The CAC 40 was down 0.48%. And the FTSE in London was also down 0.48% too. In the week, European lenders led sectoral gains, rising 1.7%, while healthcare also went higher, advancing 1.4%, as Novo Nordisk rose almost 4% to hit a record high. Technology stocks closed 1.2% higher, holding near the highest levels since December 2000, with German enterprise software giant SAP lifting 3.6% after the CEO gave encouraging guidance for 2026 and 2027. And Dutch semiconductor firm ASML also extended its gains from Wednesday, rising 1.5%. Rate-sensitive sectors like utilities and real estate, though, were amongst the laggards, falling 0.9% and 0.6% respectively. Europe's Stoxx 600 index, which had gained about 10% year-to-date, closed 0.22% lower, but still recorded its first weekly gain in 3 weeks. But following the US data reports, Eurozone rate pricing also went into reverse, with traders now pricing a 55 basis points of cuts in the region this year, down from 58 basis points before the data. And the Eurozone bonds were also lackluster on Friday, with Germany's 10-year bond yield rising to 2.6205%. On the data front, Eurozone retail sales fell more than anticipated in April, declining 0.5% against expectations of a 0.3% decline. In Asia, markets were flat on Friday, although Indian stocks rose, outperforming the bulk of their peers after the Reserve Bank of India kept interest rates steady as expected, but flagged an improved outlook for the Indian economy. India's Nifty 50 rose 2.05% after the RBI kept its policy repo rate unchanged, but hiked its outlook for annual gross domestic product growth. The RBI said that it expected GDP in the current fiscal year to be 7.2%. That's higher than its prior forecast of 7%. Indian stocks gained on Friday and saw the index trim the bulk of weekly losses, although they were still trading lower for the week after plummeting from record highs. Losses came after a BJP-led alliance clinched a smaller majority in the 2024 elections, presenting a difficult third term for the Prime Minister. Japan's Nikkei 225 and Topix indices fell about 0.2% each, weighed by growing bets that the Bank of Japan will tighten monetary policy next week, but by lowering its bond purchases. The BOJ governor reiterated plans for such a move earlier this week, while signs of a rebound in Japanese inflation and improving wages also drove up expectations of tighter policy. But other data released on Friday showed Japanese household spending fell more than expected in April, raising doubts over just how much headroom the Bank of Japan has to tighten policy. Bank of Japan was widely expected to keep its policy rate at 0 to 0.1% after that historic hike back in March, but it is expected to begin cutting its purchases of Japanese government bonds, which are currently above 6 trillion yen per month. That's the same amount as those seen in March. That's according to UBS. Japanese 10-year yields slid to over 2-week lows this week, and the Bank of Japan may also be more geared towards softer tightening after inflation readings for the past 2 months somewhat underwhelmed. UBS said that the Bank of Japan will update its policy statement to reflect plans to reduce its bond purchases. Some Bank of Japan watchers expect another rate hike from the central bank to stem recent depreciation in the Japanese yen, which had largely weakened past government intervention efforts in May. But UBS argued that the Ministry of Finance had greater impetus to manage the currency market over the Bank of Japan. Additionally, Bank of Japan officials said they'll only hike rates if yen depreciation stood to impact inflation. Recent wage data for April did show some progress towards improving consumption and higher inflation, as forecast by the Bank of Japan, and higher cash earnings grew more than expected as wage hikes won by Japanese labour unions earlier this year took effect. The yen was last at 156.74 to the US dollar. China's Shanghai Shenzhen CSI 300 and Shanghai Composite Indices fell 0.8 and 0.3% respectively on Friday after mixed trade data from the country. Losses in mainland stocks dragged Hong Kong's Hang Seng down 0.59%. Chinese stocks have remained largely range-bound in recent weeks as optimism over an economic recovery in the country soured in anticipation of more stimulus measures from Beijing. Chinese exports grew 7.6% year on year in May, according to data from the Customs Administration, which came out on Friday. The rise was much higher than expected, 6%, and rebounded sharply from the 1.2% rise seen in the prior month. Strong exports indicated that China's industrial production, which is a key economic driver, remained steady, while overseas demand was also picking up after a lull through most of last year. But consistently strong Chinese exports raised some concerns over China's biggest export destinations, imposing some curbs on Chinese goods due to oversupply and dumping concerns. The US, of course, earlier this year hiked import duties on several Chinese industries, raising concerns that other developed economies could also follow suit. Strong exports saw China's trade balance widen to a surplus of $82.62 billion compared to expectations of $70.5 billion and April's reading of $72.35 billion. But a spike in China's trade surplus was also driven by weak imports, which grew only 1.8% year on year in May. The figure was much weaker than expectations, which was at 4.2%, and slowed significantly from the 8.4% growth seen in the prior month. Weak imports indicated that even though some facets of the Chinese economy is picking up, domestic demand remains largely subdued. This trend could herald continued weakness in key aspects of the Chinese economy, particularly consumer spending and inflation. South Korea's Kospi added 1.23% in catch-up trade after a holiday on Thursday. The Australian share market capped its best week of the year so far on Friday after rate cuts from the two major central banks buoyed interest rate hopes heading into the long weekend. This despite growth as measured by GDP falling to just 0.1% in the March quarter as households' rising debt costs curbed spending, countering extra outlays by the government. On a per capita basis, GDP shrank for the fifth consecutive quarter, falling 0.4% in March and 1.3% from a year earlier. So real households are going backwards. Spending might have been worse if it had not been for big events in the quarter, including sold-out concerts from Taylor Swift and Pink. And the Australian Grand Prix was also held in the March quarter for the first time since 2019, potentially bringing forward spending from the June quarter when it's often run. The wage price index also picked up 0.8% for the quarter and remains above 4% compared to a year earlier for the third quarter in a row. Such a stint hasn't been recorded for 15 years, the ABS said. The Treasurer Jim Chalmers said the primary cause of this very weak growth was higher interest rates, combined with moderating but persistent inflation and ongoing global uncertainty. This outcome justifies the government's approach to fighting inflation without smashing the economy, when growth was already soft and people were already under pressure. And Chalmers added that these new numbers show we got the budget right. Well, we'll just see about that, won't we? On Friday, the S&P ASX 200 rose 0.49% to 7,860 points, ending less than 50 points shy of its record close that it touched in late March. Over the last days of trading, the flagship index rallied 2%. That's the best one-week gain since mid-December. The ASX's best-performing sectors were consumer discretionary and materials, which added 1.2 and 0.8% respectively. After falling for much of the week, iron ore futures in Singapore actually bounced 1.9% to 108.80 US dollars a ton on Friday, and that pushed mining major Fortescue 1.3% higher to $24.37, and BHP rose 1.09% to $44.55. Among the gold miners, Regis Resources jumped 3.5% to $1.92, and Bellevue Gold rose 1% to $1.99. In corporate news, ASX tech darling Life360 launched a second listing of shares on the Nasdaq index in the US at $27 per share. The company's location tracking app on mobile phones now has more than 66.2 million monthly active users, and the stock's local listing lost 3.5% though to $14.17. Total assets at US-based international equities manager GQG Partners jumped from 142 billion as at April the 30th to 150.1 billion as at May 31. GQG said it booked $9.1 billion in inflows in 2024. That's to May 31. The stock gained 2.3%, closing near a record high of $2.64. And shares in IDP Education bounced 5.7% to $15.33 after falling more than 7% on Thursday, when the company warned of a large reduction in business due to restrictive policies in Australia and around the world for international students. The Australian dollar bought 65.8 US cents and 51.74 UK pence. The ASX is closed for the King's birthday on Monday. Now, of course, to the big question, which is, with the Bank of Canada cutting on Wednesday night and Lagarde going on Thursday night, does this give the RBA any more room to deliver the rate cut that many Australian households and investors crave? The answer is no. As Bullock made clear in a testimony to Parliament this week, the RBA remains focused on the fact that while the economy is slowing, the economy remains above capacity. Europe and Canada are in different positions, with much more widespread signs of economic weakness over there. And while the Australian labour market remains as robust as it is, and while wage and price pressures remain as high as they are, the RBA has far less room to move than overseas counterparts. Having been slower to lift rates, it may well be that the RBA is the last of the G10 central banks to deliver a cut. The economic and interest rate cycle in Australia is actually quite different to our Canadian cousins, despite the similarity in the structure of the resource-rich, medium-sized economies. That's because the RBA didn't lift as high as Canada did. Headline inflation is 3.6% in Australia versus 2.7% in Canada. And in the more closely watched central bank terms, underlying inflation is 4% in Australia compared to 2.9% in Canada. The unemployment rate in Australia is the low of 4.1% versus 6.1% in Canada. So the RBA is higher for longer until late this year or early next, and that was reinforced by the new RBA Deputy Governor, Andrew Hauser. In an interview with the AFR this week, the RBA board is seeking to test how low unemployment can sustainably be, as agreed with Treasurer Jim Chalmers, justifying lower interest rates than foreign peers to tame inflation. Hauser said, that strategy is not without risk, because if inflation remains sticky and does not come down to the 2.5% target, it could force the RBA to tighten interest rates harder and crunch the economies more later. Headline inflation has stopped falling since December and has edged slightly higher in the past 2 months to 3.6%. If a higher than expected June quarter consumer price index is printed on 31st of July, the RBA board will be leaning towards a rate hike in August against every dovish bone in its body. In fact, Bullock said on Wednesday interest rates would be cut only when the board was convinced inflation was falling sustainably into the 2 to 3% target band. If inflation rises or remains sticky, the RBA wouldn't hesitate to move and raise interest rates again, Bullock said. She said the economy was very weak, evidenced by soft consumer spending. But Bullock drew an important distinction between everyone obsessing about the weak growth rate in demand and people paying less attention to the RBA's focus on the high level of demand. While GDP expanded by only 1.1% through the 12 months, the level of economic output through the year was $2.4 trillion. That is above the economy's capacity to sustainably produce goods and services in a low inflation way. And tepid growth, like the 0.1% in the March quarter, is necessary to rid the economy of excess demand and push it back towards the supply capacity to balance the economy. So the RBA is indeed expected to be among the last central banks to cut rates because the Australian inflation pace is above most major economies at 3.6%. CPI remains well above the RBA's 2.5% target, and a reason why money markets are only fully pricing in an easing in 1 year's time. We assume the RBA will lag easing, but now with global central banks starting to cut rates, the RBA is unlikely to remain alone forever, said George Thaniu, chief economist for Australia at UBS. That analyst expects the RBA to ease sometime in 2025. And finally, in crypto, Republican president candidate Donald Trump presented himself as a champion for cryptocurrency and slammed Democrats attempting to regulate the sector during a San Francisco fundraiser on Thursday. The crypto industry is increasingly trying to influence US politicians as it faces heightened scrutiny from regulators, especially since bankruptcies at major crypto firms in 2022 spooked investors, exposed fraud and misconduct, and left millions of investors out of pocket. Currently, Bitcoin is sitting at around 69,469, with the recent upswing in Bitcoin prices being driven by the spot market. As more people purchase Bitcoin in the spot market, of course, the price rises. Some note that bears might be in danger as open interest on the short side is slowly climbing up to a par with the spot buying volume. Such a divergence could lead to short squeezes, which, in the case of Bitcoin, could lead to a breakthrough heading towards the 100,000 level. But on the other hand, higher for longer rates and an easing of ETF flows might pull prices lower. So it continues to be a reactive and speculative market. Selling is the prevailing trend in the futures market, which may cause price adjustments or even higher volatility, which is in microcosm the story more broadly, as US and Australian interest rate cuts will be delayed as inflation remains sticky, and given extended valuations across many sectors, including AI-related, the risks are there for those who want to see them. But it's just the full-on data dependence that creates swings which traders capitalize on. But it's not good for markets nor for ordinary people, as this spurious wealth creation is more illusion than reality and, well, it could reverse quickly. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.